Right now, we are living in a market that is absolutely obsessed with trillion-dollar AI models and reusable rockets. If you just glance at the startup landscape today, you would honestly think the only way to build a billion-dollar unicorn is by writing complex code or launching satellites into orbit. But right in the middle of this massive deep tech frenzy, a really surprising new contender has emerged. They are not building microchips, they are not training neural networks. Instead, they are attempting to pull off a massive public valuation by making sustainable women's wear. Today, we are going to dive deep into the fascinating business model behind Reformation. Lately, the public markets have had a voracious appetite for almost anything related to tech, infrastructure, and defense. Consumer retail brands, on the other hand, have been largely left out in the cold. It is incredibly rare right now to see a fashion brand actually testing the waters for a major public offering, and that makes Reformation a huge test case for the entire startup ecosystem. Will investors actually back a consumer growth story in this current macro environment? To really understand how they got here, we are going to peel back this shiny brand exterior and look at exactly what makes them tick. We will start by looking at this rare fashion IPO and their fast, data-driven approach to sustainability. Then we will break down their direct-to-consumer dominance, before getting into the real battle between their growth and profitability. We also need to talk about a staggering $90 million dividend they just paid out. And finally, we will look at how this single company is testing the broader market. This whole story really gained momentum when Reformation officially filed their paperwork with the SEC. This was not just some routine, quiet filing. It was a major statement of intent. They are aiming for the absolute top tier of the public markets. What stands out immediately here is the sheer scale they're aiming for. This is a brand that has spent over a decade quietly building a massive empire. Now they are looking to raise hundreds of millions of dollars to fuel their next phase of expansion. If they manage to hit the top of their expected range, they will officially secure that highly coveted unicorn valuation status. It is a seriously bold move for a fashion brand preparing to ring the bell on the New York Stock Exchange. But how does a clothing company actually justify a unicorn price tag in today's tech-heavy market? Well, the secret is not just in the design of the clothes themselves. It actually lies in the underlying operating engine they have built right in their Los Angeles headquarters. Reformation basically operates with the speed and agility of a software company. Instead of guessing what people will want to wear 6 months from now, they just wait. They watch early traction online to see what actually gets clicks and what gets added to the cart. Only after the data proves a specific design is a winner do they trigger their LA-based manufacturing. They've completely bypassed the traditional retail trap of imprecise, long-term forecasting. They describe this internally as a smart, responsive merchandising model. By keeping their factory and distribution super local, they can literally chase virality in real time. If a dress blows up on social media on a Tuesday, they are already ramping up production by Wednesday. It is an incredibly efficient, data-driven way to completely eliminate wasted inventory. Of course, manufacturing at lightning speed is only half the battle. You still need a wildly effective way to actually sell all that product. And Reformation has built a very specific playbook to control the entire customer journey from start to finish. When you look at how they generate revenue, the vast majority comes directly from their own channels. They are not relying heavily on traditional wholesale or department store middlemen to push their products. Instead, they drive traffic straight to their own website and their own network of global retail stores. This is a massive strategic moat. It allows them to maintain total control over both the customer experience and, most importantly, their profit margins. This direct-to-consumer approach has allowed them to build an absolutely enormous, highly active customer base. We are talking about a massive army of loyal, repeat buyers who keep coming back. And these are not small, casual purchases either. Their typical customer places high-ticket orders, which generates incredible lifetime value for the brand. But getting millions of people to your website requires making serious noise. Reformation does this through some of the most unconventional marketing in the entire industry. They have tapped unexpected cultural figures for their campaigns. They ran a highly publicized voting initiative that got everyone talking. They even launched a dedicated collection partnered with a famous celebrity divorce attorney. These highly shareable, borderline provocative stunts drive massive organic traffic without having to spend heavily on boring traditional ads. Now, brilliant operations and viral marketing make for a truly great headline, but the filings submitted to the SEC tell a much more complicated, behind-the-scenes story. When you finally look under the hood, the reality of their business model starts to look very different. This right here is the ultimate tension at the heart of this company. On one hand, they have an unbelievable streak of consecutive rapid-fire revenue growth. Their top-line sales are just skyrocketing quarter after quarter. But right alongside that massive growth, their net losses are widening at an alarming rate. They are scaling their revenue aggressively, but they are burning a whole lot of cash to make it happen. When you zoom out to look at their full-year performance, the trend becomes undeniable. In previous years, they were posting incredibly healthy, robust profits. But recently, even as their total revenues soared to record highs, their overall profitability plummeted. This leaves potential public investors with a massive suspended question. Why is their profitability shrinking so dramatically while the brand itself is bigger than ever? Interestingly, the issue is not with how much it costs to make the actual clothes. Their gross margins on the products remain exceptionally high, aided in part by some international tariff rebates. The real story is what happens further down the income statement. They are pouring massive amounts of cash into expansion, operations, and those viral marketing campaigns we just talked about. They are essentially choosing to spend their way through their profit margin to capture as much market share as possible. But the aggressive spending is not the only thing raising eyebrows on Wall Street right now. Buried deep in the SEC filings is a single financial maneuver that adds a dramatic twist to this entire IPO narrative. Right before filing to go public, the company executed a massive, multi-million-dollar dividend payout. They distributed an enormous sum of cash directly back to their existing private shareholders. And they did this just days before asking public market investors to buy into the company. Pulling that much liquidity out of the business right before an IPO is an incredibly bold move. It is absolutely something institutional investors will be grilling them about during the roadshow. What is truly fascinating here is how self-aware the company is about its own edgy identity. As one analyst perfectly described it, their provocative billboard language lives right alongside stiff statutory disclosures. Reformation actually lists their own controversial marketing as a material risk factor to the business. They put the risk of offending the public right next to standard economic threats like global tariffs or supply chain issues. This entire situation represents something much bigger than just a single clothing brand going public. It is a massive stress test for the broader stock market landscape today. The current IPO market is incredibly unforgiving and highly volatile. A significant portion of companies that went public recently are already trading below their initial offering price. We have seen massive tech giants experience brutal valuation whipsaws that erase their post-IPO gains almost instantly. Investors are highly skeptical, incredibly cautious, and looking very closely at unit economics right now. Which brings us to the ultimate question for the startup ecosystem. Will public investors actually reward a non-AI growth story that is spending heavily to scale? Are Wall Street buyers truly ready to embrace a consumer retail brand in the middle of a tech-dominated era? We are about to find out just how much appetite the market really has. It is going to be fascinating to watch this play out, and I will catch you in the next one. Right now, Wall Street is pricing an offering that is aggressively challenging the conventional fashion model. We're looking at the sustainable women's wear brand Reformation as they step into the public spotlight. When you dig into their S1 filing, you find this fascinating, almost contradictory tug of war. On one side, you have stellar revenue momentum, but on the other, you see a rapidly deteriorating bottom line. It's a look right under the hood to see exactly how this direct-to-consumer pioneer is actually functioning. They're bringing just over 14 million shares to the public market in a massive liquidity event. Specifically, we're talking about 14,062,500 shares hitting the tape. That includes both brand new stock issued by the company and existing shares being offloaded by current stakeholders. So this is setting up to be a major test of the market's true appetite for direct-to-consumer retail brands right now. With an expected price range of $15 to $17 a share, underwriters JP Morgan and Morgan Stanley are clearly aiming high here. That pricing bracket reflects some serious confidence from the lead book runners, and if they hit it, it sets the stage for a highly lucrative debut on the New York Stock Exchange under the ticker symbol REF. To put that into perspective, this pricing structure gives the sustainable fashion brand an initial target valuation of up to $1 billion. Hitting that billion-dollar mark would absolutely cement Reformation as a true retail unicorn. But to understand how they're commanding that kind of premium valuation, we really need to look closely at the underlying financial mechanics driving this business. The entire foundation of this premium valuation relies on the company's undeniable momentum on the top line. Simply put, Reformation has built a highly effective revenue engine that commands attention from institutional investors. They're expanding rapidly, and honestly, the data absolutely backs this up. Net revenue surged by over 15% year over year. It climbed from $438 million in fiscal 2024 all the way to $507 million in 2025. Crossing that $500 million threshold is a massive milestone for a digitally native brand. It brilliantly illustrates the sheer scale they've managed to achieve in what is a notoriously competitive apparel market. And that momentum isn't just a fluke. This upcoming listing actually follows an incredibly impressive streak of 20 consecutive quarters of double-digit growth. Achieving 5 straight years of uninterrupted double-digit expansion is exceptionally rare in the discretionary consumer sector. It signals intense brand loyalty and highly effective market penetration over a sustained period of time. Even more compelling for institutional money is what happened recently. First quarter net revenue for 2026 actually accelerated by 30%, reaching $112 million. So they aren't just growing, they're stepping on the gas right as they approach the public markets. That is exactly the kind of trajectory that growth-focused funds actively seek out. Now, this hypergrowth is driven by an incredibly efficient direct-to-consumer distribution model that captures a staggering 90% of their total revenue. By remaining almost entirely decoupled from traditional wholesale networks and department stores, they get to retain total control over their pricing power. But perhaps more importantly, it grants them unfiltered access to consumer data and the complete end-to-end customer experience. Because they control that relationship rather than farming it out to wholesalers, Reformation expanded its active DTC customer base to 1.14 million by March of 2026. Having well over 1 million active, direct buyers is a formidable competitive moat. It essentially means they can market new products with incredibly low customer acquisition costs compared to their traditional retail peers. But here is where the financial narrative gets drastically more complicated. We have to move past the top line and examine the bottom line. And that brings up the critical tension suspended over this entire offering. If revenue is skyrocketing and the direct-to-consumer model is thriving so well, why on earth is net income plummeting? Well, while revenue grew robustly from 2024 to 2025, net income paradoxically collapsed. It fell from $33 million all the way down to just $12.6 million. We are looking at a severe financial divergence here. The top line is expanding by nearly 16%, yet the bottom line just shrank by over 60%. This profitability paradox is most evident in the first quarter of 2026. They reported a stellar gross margin of over 70%, which, frankly, is practically software-like profitability on physical goods. Yet, sitting right next to that is a widening net loss of $12.1 million in just those 13 weeks. Digging into the fine print of the filings reveals exactly why. That impressive 70% gross margin was actually artificially boosted by a 9 percentage point gain from one-time tariff rebates. These were rebates tied to the International Emergency Economic Powers Act. So the crucial takeaway for investors is that this margin expansion was largely a regulatory windfall, not a fundamental improvement in core operational efficiency. Without those rebates hiding the reality, the company's first quarter net losses have actually more than doubled year over year. They went from a $5.6 million loss in Q1 of 2025 to a $12.1 million loss in Q1 of 2026. The underlying operating expenses are clearly escalating much faster than their revenue generation. This severe margin squeeze forces public investors to ask a tough question. Is the brand simply spending its way through its margins just to maintain the illusion of exponential growth? I mean, can 20 quarters of top-line growth truly justify a rapidly shrinking bottom line ahead of a public listing? The market is going to have to aggressively analyze whether this is just a temporary investment phase or a deep, structural flaw in their expansion strategy. And the balance sheet reveals another material risk that we have to talk about. There was a massive $90 million pre-IPO dividend payout. This paints a rather concerning picture of constrained liquidity right at the exact moment the company goes public. $90 million is a highly significant chunk of capital to just remove from a growing retail business. This heavy dividend was distributed to their private equity backer, Primera, a mere 8 days before the company filed its S-1 registration statement. This is a classic private equity playbook maneuver. You extract the maximum cash value right before handing the keys over to public shareholders. However, it leaves the company itself with a much lighter cash cushion to absorb any future operational shocks. Extracting that much cash right before an IPO leaves Reformation with much tighter liquidity. It pits their aggressive physical retail expansion plans directly against the highly leveraged balance sheet. They are currently operating around 70 stores and actively expanding internationally into Europe. But funding a physical retail footprint is heavily capital intensive, and trying to execute that with elevated debt levels substantially increases the operational risk. Beyond the debt constraints, the registration statement legally obligates the company to disclose severe macro sensitivities that could impact future cash flows. The S-1 filing outlines several material risks that institutional investors are definitely scrutinizing closely during the roadshow. Let's look at the specific language management used to describe these overarching economic threats. The filing explicitly warns that their premium price point, which averages about $315 per order, makes them highly vulnerable to discretionary spending downturns and import costs. They literally cite the potential for a downturn in consumer spending alongside the unpredictable impact of ongoing U.S. tariffs. In an uncertain macroeconomic environment, asking consumers to consistently spend over $300 on non-essential apparel is a bold proposition, for sure. Then there's the sustainability aspect. If scaling physical locations under current debt constraints forces Reformation to compromise on the material integrity, they face elevated reputational risks that could rapidly erode their core brand equity. This leads us directly to the very real industry risk of color washing. If Reformation leans too heavily on cheaper synthetic materials just to protect their shrinking bottom line, they risk completely alienating the exact eco-conscious customer base that built the brand in the first place. Zooming out for a second, this offering is testing the waters of a public market that is currently fixated almost entirely on artificial intelligence and infrastructure technology. 2026 has been a year heavily dominated by mega IPOs in the AI space. So, seeing a consumer retail brand step up to the plate right now to test the waters is actually highly unusual. Reformation really serves as a crucial bellwether here. We're about to see if institutional appetite has returned at all for non-AI, direct-to-consumer growth stories. Can a physical product company with the DTC model command the kind of premium multiples we are seeing in the broader tech sector? The entire retail industry is watching this roadshow closely to gauge true public market sentiment. As the roadshow concludes and the final share price is set, the market is going to decide exactly how to penalize the divergence between their soaring revenue and their deteriorating profitability. Ultimately, investors have to determine if this sustainable fashion pioneer can actually survive the uncompromising scrutiny of the public markets. Will Wall Street reward Reformation as a billion-dollar retail unicorn or reprice it as a highly leveraged growth trap? That is the final, pivotal question that will be answered when the bell rings on IPO day.